Good afternoon, everybody. For those that don't know, my name's Stephen Kelly. I'm Chief Executive of Manufacturing Northern Ireland. You're all very welcome along today. Today we have colleagues from Barclays Corporate Banking, who are Manufacturing NI's banking partners for what is this month of May, which is Northern Ireland's Manufacturing Month. We run a series of events, both in person and online, for people to get the latest updates, to get some inspiration, to get some information around areas of their business which is of interest, and hopefully people find useful in terms of making good, safe choices for their business as they continue to grow. Today I'm very pleased to be joined by Gavin Campbell. Gavin works with Barclays here in Northern Ireland in Belfast, and will be introducing his colleagues shortly to us. The intention here is that we will have some presentations. The content of that presentation will be shared after the event, and a recording will be shared to those people online at the moment and others that have registered, as well as the wider Manufacturing NI mailing list that we have. So do feel free to consume what you're hearing from colleagues this afternoon. If you have any questions, please take the opportunity to ask those questions in either the Q&A function or the chat, which is available here on Teams. I'll look at those questions and we'll put them to our panelists that we have with us this afternoon later on. Please do try to make them as general as possible. We absolutely understand that people have very specific issues relating to their own business, but the best forum for that would be to pick up the call, right? Give Gavin a call or any of his colleagues, and I'm sure they'd be very happy to help and assist you and guide you through to get you to the right answer for those questions. As I said, I'm going to hand over to Gavin Campbell from Barclays, who will kick us off this afternoon, introduce his colleagues, and then I'll come back later on at the end of the presentation and we'll do some quick Q&A. Gavin, over to yourself.
Brilliant. Thank you very much, Stephen. Stephen said, my name is Gavin Campbell. I'm Business Development Director for Barclays Corporate here in Northern Ireland. And thanks very much for taking the time to join us today. At Barclays, we're delighted to be partnering with Manufacturing NI once again for their Manufacturing Month. I'm certainly looking forward to the series of events they will be running, and obviously culminating in the Anchor High Summit and Hall of Fame dinner at the end of May. In Barclays, we very much work on an industry-focused relationship model, and we're also delighted that Lee Collison, who heads up the manufacturing, transport and logistics sector, will actually be over at the Anchor High Summit and will be speaking there. So you'll hear a bit more from him, I suppose, around the wider UK market and what we're seeing as key trends or issues being faced by our customers right across that manufacturing sector. Today, though, we thought we'd focus very much on the financial markets side of things, I suppose with an eye on the global geopolitical situation as well, and I suppose the volatility we're all seeing on a daily basis. You'll be glad to know that I won't be the one speaking on these things. We've got experts with us to go through that. Unfortunately, we had a last minute change. So Will Hobbs, our head of UK asset management within our wealth team, has stepped into the role that Peter Gordon was going to take. Peter was called to an urgent meeting with our CEO and the government. So unfortunately, no ducking out of that for Peter. But we're very appreciative that Will is able to step in. So you will see maybe in the meeting room there, a body will appear very shortly as he's en route from another meeting. But please bear with us as he sort of joins the meeting. However, to start things off, I'm going to pass over to my colleagues, Jay Pandit and Anand Patel from our corporate FX coverage team, who both support us locally here in our sort of FX and interest rate conversations with our customers. So they're going to run through a May market outlook. And it's something that we're said to Stephen that we're very happy to run on a quarterly basis going forward. Very conscious there's lots going on, lots for you to digest as you go about your day-to-day life in your business. So we're very happy to come back on a quarterly basis and give you an update. So look, without further ado, I'll hand over to Jay, who I think's maybe got a few slides he's going to talk to as he goes through here. Jay, over to yourself.
Yeah, perfect. Thanks, Gavin. Let me just share my slides. I hope we can all see the slide currently. And just as, by way of short introduction. So yeah, my name is Jay Pandit. I work on the corporate FX sales team within Barclays, and what I do is I support a bunch of Gavin's clients in Northern Ireland, helping them manage their FX, whether that be through hedging or kind of FX payments, and generally going through sort of market color to inform clients kind of what's going on in the markets at the moment. What I've kind of detailed, as you can see on the screen, is I'll kind of run through the US, the UK, and Europe, and kind of key points that are occurring in that jurisdiction, and sort of how that is affecting FX markets, or how that has previously affected FX markets kind of over the past few months. Now, what I will do is I will start with the US, and the US essentially remains the most significant driver of volatility in global FX markets, as I'm sure we're all aware of. I'll run through what these key drivers are initially. So if we look back to before Liberation Day and the ideas around Trump's policies, what the initial sentiment was around tariffs, immigration policies, and tax cuts was that they were all inflationary, which essentially would lead markets to expect higher for longer interest rates and therefore to support that dollar. Now, post-Liberation Day, what we've seen actually is with these large and expected tariffs, that sentiment quickly shifted towards FX markets being volatile, looking at growth and how growth expectations have shifted. Now that those growth expectations are now the focus of the market, and that's essentially been softened from these policies that Trump has kind of put into place. It's the inflation narrative so the narrative around inflation concerns and the potential slowdown has really taken grip, and the potential for stagflation going forward is kind of the focus of markets. What else we've seen is the reduction in business confidence, which is driven by the uncertainty. The uncertainty, is highly disruptive to planning and investment, as you business owners are aware of, or kind of individuals who work in businesses are aware of. And it's sort of whether that outlook is positive or negative for a business. I think that clarity really enables action. And what that uncertainty at the moment has driven that kind of clarity to be reduced. Finally, what's changed is there's been increased policy volatility. So these frequent changes to tariffs, unclear direction on where policy is going within the US has really spooked markets. And what we've seen as a reaction is we've saw a kind of a significant sell-off in US assets, both in equities and bonds, and subsequently the dollar, via a classic risk-off move, which has led to sort of dollar weakness. So if we look at the dollar, kind of sterling dollar 2 months ago against, 2-3 months ago, sterling dollar before Liberation Day, it was around 120, 121. We saw it at kind of US dollar highs. Currently, we see the market at around 132, 133. The euro US dollar, we had it at around 1.03, 1.04. And we're currently at 1.12, 1.14. One thing to also kind of look at or talk about or kind of briefly touch on is there was also a period where there was concerns over central bank interdependence. That briefly flared and spooked markets even further, fueling even more risk aversion. However, that narrative has essentially calmed down now. What's the kind of overarching of that is the uncertainty really still persists in the market. Additionally, going forward, there was a Fed meeting last week, which is always a big kind of a look for FX markets. The decision for the Fed was to stay no cut. And essentially the commentary around that was the Fed is waiting for mostly the harder side of data, so the labor data, GDP, inflation, to come out to kind of guide the Fed on how they're going to kind of have their cutting cycle going forward. One thing that was also mentioned is whether the Fed can preempt a slowdown with cuts. Now, Jerome Powell quickly shut that down, saying that the situation that they're in, given the uncertainty, it's hard to sort of preempt cuts, providing that more hawkish look at markets. Now, our view on where we see rates going over the next year is our forecast is we expect the Federal Reserve to be reluctant to cut rates aggressively this year. And we maintain our call to hold also 2 cuts this year of 25 basis points in July and in September. One more thing. Oh, sorry, the slide's changed. One more thing to. Oh, sorry. One more thing to note on the US is over the weekend, there were talks between the US and China in Geneva to discuss the kind of trade, those trade talks between both the US and China. Before those trade talks, what we saw was there was a 145% tariff on the Chinese imports, and the Chinese implemented reciprocal tariffs of 125% on any US import. Now, there's been a deal struck over the weekend whereby to slash reciprocal tariffs for 90 days, therefore easing fears of kind of a damaging trade war. What we saw off the back of that was the dollar climbed against safe havens like the Japanese yen of 1.7% and 1.5% against the Swiss franc over the kind of this morning. Now, the focus going forward over the next few days will be the US Consumer Price Index coming out tomorrow, so the inflation data. That will provide an indication of how the trade spat has impacted the economy, and it will guide expectations of future kind of rate cuts for the US Federal Reserve. That's kind of it around the US. I will then move on to now sterling. Sorry, 1 second. We'll move on to sterling. Now, turning to the UK, our look at Barclays, or our kind of views on where we see sterling, is we're generally bullish sterling. Now, that's based off a few key points, which is an improved UK and EU relationship, which will contribute to the unwinding of what we would call the Brexit premium that had essentially weighed on sterling. This should also mature into what we believe is a closer trading relationship with the EU, and that, with more details, will come out in the EU summit on the 19th of May. That's going to provide more clarity on where we see that sort of relationship between us and the European Union kind of evolve into. Now, another thing to point out for the UK, or a key point, is the UK has shown kind of relative resilience against global tariffs, in part due to the trade surplus with the US and the upcoming trade deal that got announced last week, which we'll dive into a little bit in a minute, and also the kind of level of tariff compared relatively with the rest of the kind of economy at that 10% level. I'll go into the US deal in a bit, but I think what I was going to do is talk about the Bank of England meeting as well that was last week. There was the Bank of England meeting last week where the Bank of England decided to cut rates by a quarter point to 4.25% as expected. The Bank of England Governor Andrew Bailey, had noted that inflationary pressures have continued to ease, allowing for a recent rate cut, which saw our latest inflation reading at 2.6%, below expectations. Now, the impact on sterling immediately was sterling became slightly stronger on the decision. Now, we'll go into why in a minute, which is interesting. But if we talk about the commentary around what was stated in that meeting, because that's what provided a lot of drive for the currency. Now, there was no real debate about that decision. Markets priced in at 25 basis points cuts. Surveys predicted that this was going to happen pretty convincingly. However, what the driving around the movement in the currency was the hawkish sounding Bank of England decision, which provided certainly more support for the currency. Now, what they talked about in that meeting was the guidance or future guidance on policy, and how that is affected by forecasts. And what also was interesting was the vote count, kind of particularly in that meeting. Both were generally more hawkish than expected. What was expected was it to be a bit more dovish, with growth expectations softening, energy prices a little lower. However, there was not much support on that point within that meeting. Looking at the vote count, what was predicted was an 8-to-1 vote count, which was 8 to vote for a 25 points basis cut and 1 for a stay. What actually happened was it was 5 voted for a 25 basis point cut, 2 voted for a larger 50 basis point cut, while 2 voted to hold rates as they are. Now, those 2 votes that were left unchanged or for rates to stay was surprising to the market, and kind of drew some fears around, or kind of was based on the uncertainty around inflation coming down, and generally them wanting, or those 2 individuals wanting, more data or hard data around the labour market to see whether we're in a position to cut rates even further. So that was sort of interesting around that meeting. One thing to note around that is we are seeing wage growth slowing, which will form part of their focus when it comes to their decision to cut rates over the next or upcoming decisions. Our view at Barclays is that we see four rate cuts this year, or 4 consecutive rate cuts, starting in June, in August, and in September. Sorry, the first one is in May, then 3 more, 1 in June, 1 in August, and 1 in September, to bring that policy rate to 3.5%. What I'll finally move on to for the UK is the US trade deal. And also, there was a trade deal done with India as well, but I'll just kind of go over the basics of kind of what that trade deal included, and we can kind of talk about what that effect on markets was, even though it was minimal. So the trade deal included for the UK and US a 10% baseline tariff on all goods. So the 10% baseline tariff on all goods will remain in place. The UK agreed to sort of fast track American goods through their customs process and reduce some barriers to trade. And in exchange, the US offered the UK reprieve from the 25% levies on autos and steel, which were a real strain on Britain in those particular sectors. British exports on steel and aluminium would now be fully exempt from tariffs, while the first 100,000 British cars sold in the US annually, which is the vast majority which is reflective of what the total amount that was sold last year, would be subject to a reduced 10% levy. Now, although there was certainly some disappointment around that 10% baseline levy remaining in place, Barclays research does still think that the deal improves the UK outlook and supports their bullish GBP view. Now, there was not much movement initially in markets, but I think what positives came out of that meeting was particularly a view that there was deals to be made with the US, and that economies around the globe can see a way forward out of the kind of reciprocal tariff world that we're in currently. Now, one thing to add off the back of that is what is probably one thing to highlight is the trading relationship essentially with the EU is arguably more significant driver for UK growth. So how that develops, as mentioned earlier, will probably will arguably be a more significant driver for UK growth. Now, you can see what our forecasts are from a rates perspective is we see sterling dollar in this quarter moving to 137, and in the third and fourth quarter of this year going towards 1.39 and staying at that 1.39 to where we hit in the first quarter of next year, 1.40. And we see sterling euro in this quarter hit 1.19, lead up to 1.20 in the third and fourth quarter, and then head towards 1.22 in that first quarter of next year. I'll finally go on to the Eurozone and touch very briefly on the Eurozone and kind of what the key drivers are for the kind of currency as a whole. Now, looking at the Euro, and maybe you're aware of this or you've seen, is it's shown notable strength since Liberation Day, especially versus the dollar. Now, the key drivers of this is the Euro benefiting from being a liquid and cheap alternative to the US dollar. Now, during times of US policy uncertainty, it is a driver for markets. Is the Euro is essentially a very liquid or cheap alternative for investors, which is why we've seen strength in the Euro. And as long as that uncertainty persists, we expect rotation into the Euro to continue. One final thing to point from a driver perspective of the strength of the Euro is the large fiscal stimulus in Germany that was announced through government, which is kind of a big spend on infrastructure and would support or should support growth. Now, some risks in the Eurozone to look out for, I guess, is tariff risks remain a threat, particularly given the EU's large trade surplus with the US and essentially the little negotiations that have happened so far or that we've heard of in the news. And also another risk to watch out for is the German stimulus program, whilst large and whilst should drive growth, there may be some tailwinds from political fragility that may kind of limit the effectiveness. If you are aware, Friedrich Merz is the new chancellor. He initially failed to secure a majority in the vote last week, which kind of provides some instability or coalition instability, which may lead to an impact for the ability to pass key legislation through and subsequently include those stimulus measures in that. Finally, to look at from a rates perspective, the ECB remains more dovish than the Bank of England and Fed, which is sort of against the euro. And in the near term, that whilst the euro could remain supported by risk aversion and US dollar weakness, the medium-term risk tied to political uncertainty, trade frictions, and a dovish central bank leads us to our views for a euro US dollar to stay at 1.15 throughout the period of Q2, Q3, Q4, and into the first quarter of next year. And as I've mentioned, for sterling to appreciate against the euro from 1.19 up to 1.22 in the first quarter of 2026. We also finally expect rates from an ECB perspective to be cut 25 basis points at every meeting until October, which would leave the deposit rate at an expected 1.25% by the end of the year. That's sort of all I had from an FX perspective and a market perspective. I don't know, I've got my colleague Anand on the call, if there's anything you would like to add or you think I've missed.
No, that was, I think that covered broadly our general view on the market, sort of where we were 100 days ago, should we say 105 days ago, as to where we are now. I would open the floor up to any questions at this point, given Jay's given a broad outline of our forecast going forward as well, and any questions you may have off the back of that. If if it's not here now today, please do feel free to reach out to Jay or myself or anyone else here on the FX team around how some of this may impact your business and things you could be doing planning wise around sort of risk management and currency exposure management.
Can I just maybe ask a question at this point? I mean, it seems from what I've taken up from what you've presented so far that sterling is a particularly strong currency, and it's not likely to. There doesn't appear to be any threats to it at this point in time, at least. I mean, given world events, particularly what's been happening in Washington over the last number of weeks, the banks seem to be pretty resilient around, or pretty confident around the resilience of the UK economy. And is it the case that perhaps we probably have seen the worst of the news till now, and we're kind of winding our way back from the worst of that news, and because of that, there's growing confidence?
I think a lot of that is, at the moment, it certainly feels that way. However, I think it's very much a case of known unknowns and unknown unknowns, if that makes sense. Given who is in the White House and the way in which US trade policy just generally is sort of being dished out. So I'd say at this point, certainly, the pound sterling and UK equities as well, which I'm sure we'll probably speak more depth about, but yeah, just the UK generally seems to be one of the beneficiaries as sort of that de-risking, what Jay mentioned, the de-risking aspect, whereby people are sort of moving out of dollars, whether it's assets or hard currency, etc. The UK has been a major beneficiary, so has the euro. Have we seen the best of it? Very tricky to say at this stage. I think the focus outside this UK-US sort of trade deal, which may abate some of the external factors and the global geopolitical end of it, it may then the attention or the risk may now lie back in the UK itself, within the UK. And what I mean by that is what our good Chancellor does next in terms of how all these movements and sort of this pending EU deal affects the UK from a fiscal perspective and a monetary perspective as well. So in terms, I think looking at it from an external point of view, a geopolitical point of view, it certainly feels, or markets certainly feeling like we've passed the potential worst of it. However, I think there may be more to come from an internal perspective when we start to look again at those issues, which haven't gone away. I think they've just been pushed further down or out of the headlines around the UK's fiscal position, monetary spending, etc., which is obviously a different angle or a different issue when the UK is related. So whilst not a hard yes, it feels like one area is certainly doing quite well in terms of the external factors, but I think the focus very much now is on the internal factors on how long this can continue.
And Stephen, sorry to cut across. I'm delighted to say Will has been able to join us. Now, he hasn't joined the room, but he's joining from his desk. So I'm just conscious Will will cover a bit as well there, and which may set a bit more context. And then maybe we'll come back to questions then, Stephen.
I think that's
okay?
worthwhile. Yeah, we'll do that.
Yeah, Will, you okay too?
You guys, can you just check? You can hear me okay with my
We can
We
indeed.
can indeed.
section? Yeah, I was actually enjoying listening to the guys do a much better job than I can of explaining what comes next in terms of currency, fiscal, and almost everything. Because I think, you know, the main sort of piece that I would reinforce at the moment is exactly what the guys were saying, that there's a degree to which the greater the confidence someone tells you what happens next, the less you should trust them. But really, I think we've got to find a way of kind of orienting ourselves in what looks like quite a new world. And one narrative that could potentially allow you to pay a little bit less attention to Truth Social, if that is indeed what you want, is really sort of looking at, you know, what's the sort of order of causality here. Now, you know, the way that the media tells it, I think, often makes it sound like the politicians themselves are the authors of events. I would disagree with that quite strongly. My alternate sort of argument would be that actually probably you could look at technological change as the author of events, and really the politicians, much as we multiple previous times, are the kind of a tantamount to the fishermen shaking their fists at the incoming storm. Now, the reason why I say that is that if you look through prior periods, and actually one of the examples I was boring our sales force with this morning, was about the previous kind of one of the sort of previous golden ages of globalization. Now, this is perceived to be 1870 to the First World War. And actually, ironically, this is also the period that this US administration is citing as one that it wants to recreate because the US grew really strongly and had very high tariff barriers. Now, the interesting bit here is, I think this US administration has entirely misdiagnosed what worked in 1870 to the First World War. We can go into that in questions if you want to be bored a little bit more. But the reality of the time, which I think is really interesting, is that politicians were at this time getting more and more protectionist. They were raising barriers to trade substantially, both across Europe, across the world, and the US in particular. The UK may have been going in the other direction, but actually there's a sort of quite a lot of sort of common patch during this period. But what was driving the golden age for globalization was not the politicians and what they did. It was the technological context, because at this time, what you're having is the global economy being totally reorganized thanks to the steel revolution. You know, some aspects of that, you can think about the shipping revolution, which is obviously, you know, a distance shrinking technology improvement in rail. You've also got the transatlantic cable. So it's these things that are the authors of the events. The politicians, in a way, because technology is reordering the global economy and shrinking distances unevenly around the world, there's a societal backlash, which then, you know, the politicians get on top of. But if you look through that period, the thing to focus on was not the politicians as such, although at certain points there was. If you fast forward that to today, and you can see in a way that you've got a number of kind of distance shrinking technologies that are proliferating around the economy. I mean, generative AI might be perceived as that in many ways, but really you can think about video conferencing tech, and all sorts of other areas where the economy is being reorganized under our feet. And that's creating winners and losers, which in turn creates the space for, let's say, more anti-system politics, which is of the sort that we see at the moment. But again, you know, in a sense, we are coming out of a slower period of measured GDP growth, and we're probably entering a period of higher trend GDP growth based on the arrival of several new innovations from machine learning and wherever generative AI ends up and all the rest of it, that are likely to, you know, power forward productivity growth. Now, just thinking about some other things to think about in the context of the moment. I mean, I would argue that, you know, a lot of the story of the moment that, you know, Jay and the guys are trying to sort of wrestle with is very much the short-term cyclical picture, which is how much is this lurch towards nativism going to cost in GDP terms, both cyclically and then more structurally. And thinking about the transmission of these moves, and we assume now that, you know, this is really just a China-US trade war, but they are going to try and have a base level of import tariffs around the world to change some of the weight of, you know, fiscal resource. I'll go into that in a second as well. So ultimately, what we're looking at is a short-term hump, I think, and probably a slightly lower than would have been trend of GDP growth, but it doesn't have to be the end of days. And actually, I would look really to Brexit here and think about Brexit was incredibly disruptive for the economy, but neither the worst nor the best case sort of scenarios talked about on the campaign trail were anything close to what was realized. And if you look at the latest incoming data on the hit from Brexit, the cumulative hit, it's tiny. And the reality is that it's not that the doomsayers were entirely wrong in the direction of travel, but what they perpetually underpriced was the adaptability of the companies and individuals on the ground. That is always the hardest thing to model. And I would actually look again and probably say the same is true of the US-China trade war, is that under most scenarios, and not all, that are kind of muddled through is likely what's underpriced. We want to be careful a little bit of the kind of the big idea, the big seismic change in wherever to whatever. Those kind of theories are always easier to seed at moments of kind of market disruption. It shouldn't make them necessarily massively more likely. For the UK specifically, I would just say that remember that, and just augmenting the guy's points there, that remember that the UK, although real wage growth has been slowing around the world, it is still in positive territory in quite a lot of the developed world. This is a powerful and under-acknowledged economic force. If you've got a consumer enjoying strong balance sheet strength, as you do in the UK and the US, and that's aggregate balance sheet, we're not talking about the distributional issues, and you've got most of the people who want work having work, and in aggregate enjoying positive real wages, you would tend to be even more innocent until proven guilty with regards to the outlook for the economy than normal. So yes, there is a unknown hit coming down the pike, but I wouldn't be too gloomy about the outlook. But there are some hard choices, I guess, for the politicians now with regards to who do you cozy up to. For me, I have to say that in aggregate, the US-UK trade deal was probably a bit of a nothing burger, even though you can see some of the sort of underlying effects. But if we think that the USMCA, the renegotiation of the NAFTA, the North American free trade agreement during Trump 1, that took 2 years. And the changes were cosmetic in reality. I mean, quite cosmetic. I'm sure there are people on this call who'd be able to tell me meaningful details, but really about sort of, slight changes to rules of origin and other stuff. This wasn't like a major kind of reordering of the trade deal, and that took 2 years. So we should, as with this UK deal and as with the talk of a China deal, I think, there's an aspect which is going to be quite performative. But I guess the sooner we can get back down and onto a more normal keel, the better. I've rattled on without much sort of framework, hoping to add to what the guy says. But I guess, I would second what the guys say. Questions, abuse, disagreements. My main message is everything doesn't have to be horrible. It can be okay. And don't believe all that you read, which you guys know already.
Well, is it a case of keep calm and carry on?
But Stephen, I do think so, I have to say. And there's two reasons for this. One, and this is a problem that economists generally have, is that the most important parts of the growth process are invisible to modern economic statistics. Transfers of useful knowledge, all of this kind of stuff, you just can't see it happening. You can barely see the important, the other bits of the growth process actually happening. And you juxtapose or you ally that to a media that is incentivized by us to be negative and give us an outrage of disgust and nothing more. And you get this kind of ultimately always negative view on the UK economy, because there's always the scope to be negative on it in the context of the missing statistics as such. Now, there is actually, I think, incoming quite decent evidence to show that optimism, and this is without even going into the reality, which I'll come to in a second, optimism does matter in economics, that it can ultimately, optimistic companies hire more, they invest more, and that is good at times when there is an attractive opportunity to exploit on the technological frontier. Now, for the last period, I'd say going up to the pandemic, there wasn't, convincing evidence around the world that there was that sort of, that attractive opportunity from, stepped up investment. That looks very different in the wake of the pandemic and other sort of new incoming changes. And actually the US economy already showed a step up in productivity, not from generative AI at all. It's actually just about implementing machine learning and various other bits. So I think there is an incentive for the UK corporate space to use this opportunity to catch up in a sense, because I think one thing that's known about the UK for the last 15 or so years is that totally understandably, the UK's corporate sector has been sort of bludgeoned back into sort of survive till the end of the year mode, just because you've had crisis after crisis after crisis after political change after industrial strategy change, and that's the story for Europe. And not all of it is, not all of it is our fault, is it? But you've just had a period, I think, where it's been very hard for the corporate sector to look above the parapet and say, I'm going to take a 10-year view and invest accordingly. It may not be this 10 years. My hunch is it is, though. And my hunch is that there is an opportunity to invest and invest profitably. And just one final point, I guess, on this about geopolitics and the other stuff is that one of the sort of famous periods for the world economy of fast productivity growth and living standards growth and all the rest of it is the 1950s and 60s. Now, if you think about geopolitics during this period, I mean, it's way worse in any kind of way you want to measure it than what we see around us today. Yes, I mean, today can get a lot uglier, and yes, we've got all sorts of threats behind. But just think about the 1950s and 60s when you had, memory of far worse. You had the Korean War where General MacArthur turns around and says, I want to drop 30 atom bombs on China. You have Vietnam, France, America getting involved there. You have the Great Leap Forward. What is it, 40, 50 million potential casualties there. So you've got this kind of disastrous geopolitical backdrop, and yet you've got this surging productivity and living standards and markets during this period. So what's driving it? It's the new inventions. It's all sorts of things like the transistor radio, the sort of the final pieces of electrification and what that does to sort of factory processes. All these kind of things come together and they totally overwhelm what the media are rightly talking about. And I think that is, again, one of these moments that we've got to think about with reference to the moment.
And Will, in the context, it's a Monday afternoon, and I'm already feeling a lot better having listened to you. Thankfully, given the diet that we're fed and what we're witnessing with our own eyes, it can be incredibly confusing on one level, but scary on another level. But you're telling us here that actually what's presented is a tremendous opportunity, and when you combine that with, I suppose, two things. One is the UK has a really good policy environment, particularly around innovation, R&D tax credits, patent box, etc., etc., etc. Really good policy basis around capital investments. With people making capital investments now, financially, it's a good time to do it. Combined with when we talk to your colleagues in Belfast and indeed the other banks, there's a lot of money on deposit that's been built up over the last number of years. So if you get money on deposit, a helpful tax regime around innovation and capital investment, combined and meeting that market opportunity that you say, why would people not do this now? What's holding them back?
I think you're exactly right on all of the above. One of the missing pieces in the puzzle, I think, is a slightly less ADHD policy environment. I think one of the things that is, and I can say this as someone a sufferer, but I mean, one of the things that sort of was pointed out that, if you take in the end of the last Labour government, so the last bit of Gordon Brown, right up to the present day, I think you've got 16 different industrial policies in 17 years. That's impossible. As you know, I mean, as a business that is trying to, and this is what I think Barclays has got a big sort of role and has a big role in trying to solve for this in many ways and create sort of advisory hubs along with the other banks that can sort of provide accessible support to businesses looking to know where to access it and what to do. But that requires, in that kind of environment where it's changing every year, it requires kind of law industry type extra knowledge to be able to, just to access the patchwork of stuff that exists. And I think quite a lot of this stuff, you just need to stand still. And I think the UK, one of the things that's been lost and is being lost in the US a little bit at the moment, is the idea that actually institutions need to be grey and boring. It's all the action happens in the private sector where the companies, and life is exciting enough for companies without having constant changes in policy backdrop. So in a sense, I think that actually the missing piece in the puzzle is a bit of just sit on your hands from the government and try and provide as much predictability in an uncertain world as possible. And the second piece, actually, I think it's got worse recently, and I'm not sure whether I can sort of link implied causation here, but what I can certainly say in measured terms, and you've got sort of natural language processing attempts at doing this, is that the tone of news has become worse, and that's not connected with the reality. In a sense, it's the advent of social media has hotted up the competition for our eyeballs, and they've realized what keeps us, what's going to make us pause. And that is, like I say, outrage and disgust, so that we can spew it back all over each other around the world at all times of the day. But I think there's between, yesterday, 106,000 people were dragged out of absolute poverty, and every day for the last 35 years. A headline, is it? But it's a truth. Yeah. And so in a sense, I think we need to focus a little bit on not this kind of baseless pessimism, which is increasingly pervasive, but just what we can act and do without worrying too much about all of that.
What we see and know to be real rather than perceive to be real.
Yeah.
Last question from myself for you, and then to colleagues on the 11th floor in that meeting room that they have there. You talk about, and there's an appeal for boring government. Absolutely. As somebody who represents the manufacturing community here in Northern Ireland, we've had quite a ride for the last 9 years, from 2016 onwards, to say the least. But we're obviously coming to next month. The UK government is planning to publish its spending review, and that's probably a question for colleagues on the 11th floor there, or to hand over to them. But we're also getting a new industrial strategy, our 17th or 18th in the last number of years, as you say. What should be in that? What should it look like as in broadest terms?
So good question, Stephen. On the industrial strategy side of things, there's the consultation already published, and it's called Invest 2035, which already kind of, just the title hints at a truth, which is this can't be Invest 2027. It's got to be a 10-year strategy to be able to allow people to cluster around it. And to be honest, the economists involved, they're all, I really rate them on. We've got loads of, in the UK, this is one of the sort of big advantages we have in the UK. We've got some of the world's best universities. And so the research frontier in UK productivity, how to get it going, policy and so on, and associated, it's all there. And actually, if you listen to is it Productivity Puzzles podcast with Bart Van Eyck? He does something in Manchester. He's extremely good, very interesting to follow, and he's been a big advisor on this. Marina Mazzucato is another one, I think, who's kind of, you'll sense her authorship in there. And in terms of the finances side of things, again, this goes back to the media bit, which is that the media is incentivized to give us the kind of the bottom case scenario or somewhere near it. So we can say that there is the potential that the Chancellor has to come back and think of more ways to raise finance to plug holes. But there are also muddle through and better scenarios where actually that's not the case. So in a sense, it's about sort of handicapping them accordingly. I personally don't worry about the UK's debt to GDP. I think that's, again, a total waste of time worrying about. We've borrowed way more in the past, and it's not been a problem. It's all about confidence that you can give to the government, to the markets, about how you're going to spend it and do it. So yes, everything's going to be fine.
That's good. And Jay and colleagues in the other room, two things, I suppose. One is, what do we expect from the potential announcements in June from the UK government around its spending review? And two, Will challenged us all earlier to say that the greater confidence that someone expresses about particular events, the less you should trust them. And the analysis from yourselves earlier was that we'll probably have 3 or 4 consecutive rate cuts to 3.5%. What's your kind of confidence levels on that?
Yeah. Firstly, I guess I'll kick off by saying absolutely agree with Will on the fact that the more someone tells us absolutely certain about something, especially in markets, the less certainty you should actually put behind it. So touching on, I'm just going to bring it back, Stephen, to the first part of the question. So in terms of the spending review, at the moment, I mean, it's pretty widely publicised. There will be a series of cuts, and when we are expecting, and it's very much a case of how much and where. It seems from what we can glean at this point, the Chancellor will be trying to win back that headroom. So obviously she's imposed these self-imposed fiscal goals where the UK's day-to-day spending should be covered by taxation or sort of the natural income they already have, as opposed to external borrowing. And by some would argue this constrains her, as previous governments haven't done, and as Will again just rightly alluded to in the past, the government has borrowed way more, and we haven't sort of the world hasn't ended in the UK, as it were. But given these constraints, we think that the main aim will be the cost cutting, and it will be very much around very targeted social security. Because obviously that is the biggest expenditure within the overall UK budget, so that's sort of right, if you like, or the easiest place to start. Whilst I won't comment on how controversial or which sector is right or wrong in terms of what she should be targeting, but the news generally seems to be they want to up the spending in defence, which they've already made very public, and to pay for it, essentially they're going to be aiming for social security and possibly trimming around the edges of the NHS. But again, NHS are very political hot potato, so there's not much there. The other aspect of this is, in order to raise that sort of gap, if you like, is around tax rises. Now, considering they've already brought in the NI jump, just which should be sort of we're starting to feel in the next sort of few months, if you like, and the income tax threshold being where it is, that's going to be a very tricky one to approach. So I think the general Barclays view at the moment is it'll be very much targeted at cost cutting as opposed to tax rises. So yeah, at the moment there's not much there, but that's what we can glean from the information at hand. I believe there will probably be something out there published via ourselves or the research team around the budget announcement later on next week or the week after. So I'm sure there'll be something coming out for those who don't subscribe. If you get the FX daily markets update, I'm sure you'll get some more info as and when it comes out on there. But yeah, for the time being, quite sort of limited in terms of what we think will happen. We're pretty sure. I think it's very widely publicised. It'll be targeted around the cost cutting and not so much around the tax raises end of things. To the second part of the question, which was around certainty and how confident we are, and in the forecast that Jay sort of went over and mentioned earlier, there are a whole bunch of people much cleverer and smarter than us sitting in a room down in the basement who crunch these things out. And look, like with all forecasts and with all predictions, as it were, the information you get out is only as good as the information we can glean and the information we get put in. A lot, obviously, our assumptions and a lot of what comes out at the forecast end is based around economic data, around political analysis, around some of the bigger macro thinking that Will touched on, and we sort of put it all together and come out with a forecast. Our confidence level, if you like, is, I would say, somewhere in the mid-range. So we're not extremely confident, but I think coming off some of the latest research, there's very much a wide skew. And again, this comes back to the uncertainty argument. There could be a wide skew up or down on that. So I think it's probably less. I would say our confidence has probably decreased significantly over the last probably 6 months or so since the turn of the year, and the uncertainty, obviously, the impact that tariffs will bring or are bringing. So at this level in time, I think it's not massively high. With in the mid range where there's plenty of skew to go up or down. Sorry, not an absolute answer, Stephen, but I think at this point, given the uncertainty and unpredictability, it's probably the best I can give you.
Well, it's better than the predictions that I have on either the Cheltenham Racing Festival or the Premier League title in the last year. So I'll take it. I'll take it for now. That's all the questions that I've been sent, and I had a couple of my own in there as well. Gavin, I'll hand back to yourself.
Yeah, I'll just wrap things up. Firstly, again, just to thank people for dialing in, and also thanking my colleagues Jay and Will. Will and Jay are both over with us later on in May as well. So both keen supporters of what we do over here locally. And as was sort of alluded to at the start, if there is anything more specific you'd like to pick up, either you can reach out through the guys at Manufacturing and I with myself, and I can pick up with the guys then after that, or you're more than happy to come out directly to ourselves as well. But look, thanks Stephen again very much for hosting, and look forward to seeing some of you at the Anchor High Summit later in the month, if not before.
Thank you, Gavin and colleagues. I found that incredibly useful, interesting and entertaining in parts as well, which is says a lot about my life. So I really, really appreciate it. As I said at the beginning, we will be sharing a recording on the slides. Do sign up. I think those daily FX briefings sound like that's something that people should really do from today. If people have a specific question about relating to their business, do get in contact with us. We'll happily put you in touch with Gavin and his colleagues based in Belfast, and they can come and have a conversation with you. We'll see you again. We're going to be doing these as a regular series of events alongside Barclays in particular themes and areas. Today's been the first of that series. Remember, Manufacturing Month is the month of May. It's a great opportunity to celebrate our sector, and it's great that people have come along and joined us this afternoon. Gavin, colleagues, thank you very much. We'll catch you again soon.